three stocks to buy and hold in long term. Over the past 2 years, solar manufacturers have been hampered by supply chain disruptions, including increased material costs for polysilicon. In the last year, Rystad Energy estimated a rise in equipment and shipping costs could lead to postponement or cancellation of 56% of worldwide utility-scale solar projects that had been planned for 2022. Luckily, these challenges have been rapidly fading. Energy prices are falling back to pre-war levels, driven back by fears of a global recession and weak oil demand in China due to COVID outbreaks. The same scenario is unraveling in the solar sector, with Bloomberg New Energy Finance (BNEF) reporting that costs of solar materials have dropped by more than a third since mid-November. The price of wafers have fallen even more sharply, with wafer costs falling as much as 21% this week alone. This development has inspired Wall Street to turn bullish on the sector. Goldman Sachs has predicted that the sector will record a compound annual growth rate (CAGR) of 18% for solar installation through 2026, fueled at least in part by the supported provision of the Inflation Reduction Act (IRA), as well as falling costs. Goldman Sachs five-star analyst Brown Lee has tapped three solar stocks as good buying propositions, saying they hold at least 50% upside over the time frame. Another big reason why the sector is likely to remain hot for years, solar is by far the cheapest source of energy, with new utility-scale solar projects having roughly half the cost of coal and natural gas. The first is now least is First Solar, with a market cap of $15.5 billion and 12-month return of 74.2%. First Solar is the largest US-based developer of solar panels with a focus on utility-scale panels. First Panel says it has the ability to manufacture 20+ gigawatt of panel capacity annually and has spent $1.5 billion cumulatively in R&D since its founding in 1999. Goldman Sachs' Brian Lee has projected that First Solar will be one of the companies that will benefit the most from the IRA. FSLR currently has approximately 3 gigawatt US capacity, positioning the company as an immediate beneficiary of the IRA manufacturing tax credit. Now, FSLR expects to reach approximately 7 gigawatt nameplate capacity in the US by year-end 2023 and approximately 10 gigawatt by year-end 2025. Assuming FSLR qualifies for the 0.17 watt dollar credit, we estimate that this credit accounts for approximately 60% of FSLR's ASP, and the 10 gigawatt capacity would imply an after-tax benefit of approximately $1.4 billion a year. Now, last year, First Solar announced that it will build a new solar panel manufacturing facility in the southeast of the U.S. In November, the company picked Lawrence County in Alabama as the location of its $1.1 billion factory. The company also plans to spend $185 million upgrading and expanding its existing facilities in Ohio. The announcement came hot on the heels of the passing of the IRA Act, underpinning the impact it's likely to have on First Solar's business. However, not every Wall Street analyst is bullish on the FSLR, especially over the short term, with JP Morgan saying the easy money has likely been made, while GLJ Research has downgraded the stock from a buy to a sell. The second on the list is Enphase Energy, with a market cap of $32.7 billion and a 12-month return of 52.9%. Enphase Energy is the leading designer and manufacturer of solar inverters, a critical hardware used in all solar energy installations. Over the past 3 years, Enphase has recorded steady earnings and revenue growth, with earnings in Q3 2022 clocking in at $634.7 million, a quarter record and good for an impressive 80% year-over-year growth. Even more remarkable is that Enphase is not only solidly profitable but also owns one of the biggest profit margin amongst the leading solar names, with a gross margin north of 40%. Its nearest rival in this regard is SolarEdge Technologies, with GM of 29%. Interestingly, SolarEdge is one of the solar stocks that have recently received an upgrade. Last month, Cowen reiterated its outperform rating on SEDG and hiked its price target to $360 from $309, with analyst Jeffrey Osborne writing that SEDG is well positioned to benefit from the secular solar demand driven by policy and higher electricity rates. Regarding IRA's effect on Enphase, analyst Brian Reed notes that it is potentially a direct and near-term beneficiary of manufacturing credits. Now, assuming ENPH were to establish US capacity, ENPH will be eligible to capture the full amount of this credit, according to management. In addition, we believe that ENPH is well positioned to benefit from the extension of the solar ITC, which we believe will be supportive of a more stable demand environment for both residential and commercial solar and storage installation in the U.S., according to the analyst. And the last on our list is Array Technologies, with a market cap of $2.8 billion and 12-month revenue of 31.3%. Now, Albuquerque, New Mexico-based Array Technologies designs and manufactures solar ground monitoring system. This company became famous for all the wrong reasons after the stock crashed spectacularly following its October 2021 IPO. Thankfully, the shares have lately spurted back to life, with ARRY up 31% over the past 12 months. Lately, ARRY seems to be getting plenty of love on Wall Street, with Brown Lee predicting it will be an immediate beneficiary of the demand tailwind from the IRA. Now, Lee specifically highlights the extension of the solar ITC at 30% for the next decade, lending a great amount of certainty to the market. 2 weeks ago, Cantor Fitzgerald rated ARRY overweight. We believe Array is a logical long-term partner for engineering, procurement and construction firms and utility-scale solar operators given the company's proven track record, robust supply chain and differentiated product offering, Derek Soderberg wrote in an investor note. 2 months ago, Piper Sandler upgraded ARRY shares to overweight from neutral with a $28 price target, good for 53% upside, saying they foresee an improved forward outlook for the renewable energy firm.